Most of the AI data centers being announced right now will never be built. And the chips that would fill them depend on a single island that every major government privately considers indefensible. That is the actual state of the AI infrastructure boom, and it has direct consequences for where your money is going. AI investment narratives are moving markets, but the infrastructure those narratives depend on, chips, fabs, power grids, and the geopolitical stability to run them, is far more fragile than headlines suggest. The gap between story and reality is where risk lives. On Alex Kantrowitz's Big Technology podcast, journalists Anissa Gardizi, Max Cherney, and Lauren Good made a pointed argument. A significant portion of announced AI data center projects will not materialize on time or at all. The announcements, they argued, are inflating expectations for chip demand in ways that distort markets and public understanding. The Wall Street Journal's reporting supports this directly, flagging that actual construction progress routinely lags the scale of headline investment figures. Bloomberg Originals pushes back with a partial challenge. AI is genuinely straining the semiconductor supply chain in ways that validate real, not just announced demand. The picture that emerges is not simple hype versus reality. It is a mix of genuine demand being overstated by performative announcements, making it very difficult to price the actual build-out. Here is where the panel fractures. Gardizi and Good argue NVIDIA's CUDA software ecosystem represents a decade of developer lock-in. Switching costs are real and self-reinforcing. Max Cherney disagrees. His position, AMD's open-source ROCm push, combined with Google's TPUs, Amazon's Trainium, and Microsoft's Maya chips, represents a structural shift that will progressively erode NVIDIA's pricing power. CNBC's reporting on GPU comparisons reinforces Cherney's concern. Hyperscalers are not experimenting with custom silicon. They are deploying it at scale to reduce dependence on NVIDIA. The moat is real. The question is whether it is shrinking faster than the market has priced in. Two things cross every source in this analysis. First, Taiwan's concentration of advanced chip manufacturing is a systemic risk the industry acknowledges but has not meaningfully mitigated. Behind Asia, FD Finance and the Wall Street Journal all reach the same conclusion. Diversification efforts in Arizona and Japan are real, but remain years behind where they need to be. Second, announced AI investment figures are substantially overstated relative to what will actually get built. Investors, supply chains, and policymakers are all working from inflated signals. 3 concrete moves. 1. Before acting on AI infrastructure stocks, cross-reference announced data center projects against actual construction permit filings and power grid interconnection queues in those regions. Announcements are marketing, permits are reality. 2. On every hyperscaler earnings call, Google, Amazon, Microsoft listen specifically for the ratio of in-house ASIC deployment versus third-party GPU procurement. That ratio is the leading indicator of how fast NVIDIA's market share is actually moving. If this kind of breakdown is useful, subscribing means you won't miss the next one. 3. Track TSMC fab construction progress in Arizona and Japan as a concrete measure of whether Taiwan dependency is being reduced or is still essentially unchanged. Forced choice for the comments. Do you think NVIDIA's CUDA moat holds for another 5 years? Or are hyperscaler custom chips the beginning of the end for GPU dominance? All source links are in the description.